I'm a contrarian in general, so just creatively structuring deals sets us apart significantly because we're able to stack incentives on top of incentives for investors. The active investors have received almost a 60% return just from tax incentives and dividends, just because we were able to stack those tax incentives on top of the investment strategy, all within the fund. Make sure that you're building your business around a space that you understand so that you're not forcing yourself to be somebody that you're not. My aha moment in starting Alternative Wealth Partners was because I was in a family office environment where there were billions of dollars moving around. And I was hired for a very specific reason because of my background in oil and gas. And I realized very quickly I was only in that space for about 90 days with this particular family office, where I realized that I was the only person with any experience in this industry, and they had a lot of money at risk, and I just couldn't confidently support their investment strategy. Um, and that was my thing. That was my aha moment of realizing maybe I should just do this on my own. This is like kind of the third thing that's happened in my career that said, hey, you're the smartest person in this space. You need to go be a leader now. And I've had people tell me about 2 years prior that I needed to go out on my own anyways, but I was young. At that point, I was like 28. And I didn't think that I could do it. I didn't have the confidence. But that particular experience gave me the confidence to go out on my own. My edge in business, as far as our investment strategy goes, is the diversification and kind of holistic approach to that diversification strategy. Because we invest across asset class and across industry, we find unique ways to blend energy into infrastructure and infrastructure into manufacturing and then back into tech or hardware. And so I think just about creatively and contrary, like I'm a contrarian in general. So just creatively structuring deals sets us apart significantly because we're able to stack incentives on top of incentives for investors. So our return isn't just coming from revenue of businesses, it's also coming from the complex tax strategies that we build into our investment strategies. So in my first fund, which is the AWP Diversity Fund 1, was really kind of a proof of concept of this diversification across asset class strategy. We blended active oil and gas tax deductions with our passive deductions in real estate, with our gains and harvested losses from either debt investments or equity investments. So investors that experience their active losses, if they were in my funds, we structure them as passive or active investors. The active investors have received almost a 60% return just from tax incentives and dividends, just because we were able to stack those tax incentives on top of the investment strategy, all within the fund. So both my parents are CPAs. My father worked for PricewaterhouseCoopers. My mother worked for privately owned companies. But because I was earning six figures in high school, I've been doing my taxes since I was 16. And so I have a deeply rooted purpose of why would you make all this money if you have to pay it all back in taxes? And so when I think about the investments we're making and the returns, I also think about what is the tax burden related to that investment return. So if I can think about that before I even make the investment, then I can plan ahead for what that return is going to do to someone's tax situation. So how can we put in as much benefit against that income as possible as it gets passed through to the investors? So it's constantly top of mind when we're building these investment strategies. Alternative Wealth Partners is a private equity company based out of Dallas, and I started it with the goal of being, transparent and accessible for kind of any level of investor. While you still have to be accredited to invest in alternative wealth partners, we just break down this kind of complex concept of private equity for the retail investor. I want more and more people to invest in the alternative space. It's an awesome place to be because there's so many opportunities. You can invest in any type of industry in any type of way. You can do equity investments, you can do debt investments, you can do blended investments. You can just get really, really creative with this industry. And I just didn't see a product out there that allowed investors access to a diversified portfolio of alts, privately owned assets. And so I just created it. And I think that that's the coolest part about this space is that you can get really creative with your deal structure. You can get really creative with your investment structure. And that was why I created Alternative Wealth Partners. That's what sets it apart. We bring in a lot of strategy around tax. We bring a lot of strategy around diversification. And that's really what sets us apart because there's no one else doing it this way. Alternative Wealth Partners works with what I call everyday millionaires. There's 25 million millionaires in the United States as of right now. That's a lot of people that all have real access to alternatives. Most of the barrier to entry to the alternative asset classes is that you are an accredited investor, meaning you have over $1 million net worth, you make over 250 grand a year. There's those thresholds that you have to hit, but 25 million people who meet that threshold is pretty significant. You have a wide base of investors that have access to these types of opportunities. They just don't know about it. When you're thinking about building your business to work with your everyday millionaires, you have to understand that they have their own unique set of problems. When we're talking about everyday millionaires, these are people that have small businesses that make maybe a couple $1,000,000 a year and they're taking home $500,000 or $1,000,000. Or maybe they're an executive that's making $300,000 to $500,000 a year, maybe making $1,000,000 in bonuses. Like you have to understand what their walk of life is and build products that make sense to them. If you have, I'm a little bit of a crazy person, I think, because I've had so much exposure to different types of people. So I relate a lot to different communities. But if you have a lot of experience working with people that are in the small business space, maybe in the retail space, that you know a lot of people that own restaurants, like just make sure that you're building your business around a space that you understand so that you're not forcing yourself to be somebody that you're not. And that's okay. If you can only work with physicians or you can only work with, restaurant owners or real estate people, like that's okay. Just understand your community that you're working with and build a product around that. I think raising capital for a lot of different projects really set me up for success for raising capital on my concept because it was so project based when I was raising capital 5 million to $10 million at a time that when I went out on my own to have this kind of like high level diversified strategy where we were going to be in a lot of different projects. Our first fund was in 28 different portfolio companies. If I had to explain 28 different portfolio companies to every single investor, I would not raise any money. But getting them to understand the concept of investing in multiple assets and why they were connected, I think helped a lot being able to, if I had to, break down and pitch every single one of our portfolio companies. At any given time, I can go through every single one of our investments with anybody that had any questions. I think that's what really makes you a good fund manager is if you can really understand what you're invested in and be able to talk to an investor or really anyone about the specific project, but getting to understand your thesis is more important. Sometimes I describe our funds as like VC that pays dividends because we blend traditional assets, hard assets like oil and gas, real estate, private credit, debt lending, these types of things that everybody really understands. It provides a pretty standard or traditional return. You're somewhere between 8 and 12%. They understand how royalties are paid out. They understand how rental revenue is paid out. We're blending that thing that makes people comfortable, building that foundation on traditional assets in the alternative space with these more venture-esque type investments. So equity only, where we're buying businesses or we're investing in startups, blending that return with the traditional is how we get set apart because no one else is delivering a return like that. Alternative Wealth Partners mitigates risk through diversification. It's like the point of our entire strategy. And it's because when you invest only in oil or if you invest only in real estate, you're exposed to only that risk profile. And it gives you a lot of exposure there to things that could be really bad. Like, let's say you were invested in commercial real estate the last few years. Now, in 2024, you're feeling a lot of pressure over commercial real estate because rates have gone up. If you're only invested in that space or a majority of your net worth is in real estate, like how are you going to pivot away from there? I wanted to build a product that gave exposure to each of these different types of industries and pulling the good out of them while mitigating risk because we're hedging with one other type of industry with another. When real estate fluctuates, oil and gas goes up. When oil and gas goes up, these other things are affected in a negative way. But when it goes down, all these other things go up. So the blended approach really offsets a lot of that risk. And then building in the tax strategy even further offsets that risk because if there is loss, then we get to take that loss and offset a gain somewhere else. When you're thinking about building your portfolio inside of your fund, you really need to think about the different types of risks that come from external markets. Um, we're in a very difficult time where public markets are very volatile. There's a lot of geopolitical risk, but you have to think about at the industry level and what level you're investing in that industry. Is it relative to you locally? Or are you investing at a global level? Like what kind of um, industry are you in? For me, oil and gas is a global commodity. So I have to pay attention to everything that's happening on all over the world. So if you're going to be in the real estate space, you might be more area specific. Your risks are going to be based on where you're invested in your real estate. So you just have to keep an open mind and make sure that you're researching and paying attention to the different market risk and adjusting accordingly. Make sure that your strategy is flexible enough to handle things that are happening inside and outside of the market you're invested in. The due diligence process varies based on what industry I'm in, my level of expertise in each space. Obviously, I have a lot of experience in oil and gas, so it's a lot of existing relationships that I have where I'm getting brought deals that, will never see the light of day. It's very exclusive to the family offices or the individuals that are invested in that world. So it doesn't take a lot of due diligence to do a project in that space. But as far as the tech world goes, like I'm not a techie, I'm not a programmer, not an engineer, anything like that. I don't have a lot of experience on the tech side. So whenever I'm presented an opportunity in the startup space, especially when it comes to technology or software, then I bring in a lot of experts in that space to help break down those opportunities. And then I see, is this applicable to other things that I'm invested in? Can I understand the market around the software? I don't necessarily have to understand how it works, but how it can infiltrate a certain space. The alternative space is perceived to be extremely high risk, and it has the concept of high risk and high reward. But the reality is that there's just as much risk in the public markets as there are in the private markets. And my opinion is actually you have more control in the private markets than you do the public markets, just because there's so many external factors there. Somebody could tweet something, somebody could, get a picture taken of them somewhere and it ruined the entire market for the entire day. As far as the private markets go, you have a lot of control of what is the exposure to risk when you are directly invested in an opportunity. That's why I love the all space. You can kind of manipulate your own asset because there's not a lot of people involved at that point. It could be just you as an investor. It could be you and a group of investors. The risk is a lot easier to control in the private space than the public space.